Okay, so in this video we are going to discuss about Ind AS 7, which is on cash flow statement. Now from an exam perspective, this is, I would say, a relatively mediocre importance because there is a lot of material in your CA intermediate for cash flow statement which they have already tested to prepare the cash flow statement. However, in this chapter at your finals, what institute expects is your ability to kind of play around with those small nuances of cash flow. How will you tackle the foreign exchange adjustments, deferred tax adjustments, if any, if let us say there are certain interest on zero coupon debentures or bonds. So lot of smaller adjustments are going to be the focus area over here, rather than the traditional preparation of a full-fledged cash flow statement, which is very unlikely, because if you look at your 70-mark paper, 14 marks descriptive are going to taken up by consolidation, business combination. We have 56 marks which are remaining, and within those, if they ask you preparing a full statement, again it's a little unlikely, and even if it comes, it will be a relatively smaller cash flow statement to be prepared. So when we look at a cash flow statement, a few things that you should know before you proceed. First of all, it is one of the core financial statements, which means it is something which is to be prepared along with the balance sheet and profit and loss, and not just hidden somewhere in the notes like a related party or segment report. It is a core financial statement, needs to be prepared by all entities in both the consolidated as well as the separate standalone financial statements. Further, when we are looking at a cash flow statement, it is a for the period concept and not an as on date concept. And when you are preparing the cash flow, it is nothing but a vertical systematic presentation of the cash bank account. If I just give my bank passbook or the bank statement, there will be so many entries, it will be very intimidating for a reader to understand where the cash is actually flowing. However, we need to know from where are you earning cash, which are the activities which are used for spending cash, and that is what cash flow statement does very beautifully. It presents a statement by dividing all your cash flows into three major categories, which are: first is operating, second is investing, third is financing. What do each of these mean? When I look at, let us say, an operating cash flow, these would be cash flows which arise in the day-to-day course of your business. Let's say collection from debtors, payment to suppliers, salaries paid, advertisement expenses paid, rent paid. All of these which are linked to operations are going to go into the cash flow from operating. Again, taxes paid which are connected to, let us say, these operating activities, like taxes under the head of PGBP, will, for example, go under cash flow from operating. So what is there in investing? Well, if I were to invest money in a long term, let's say asset like a PP or an intangible or an investment property, or even investment in shares, debentures, or even in SFS, investment in subsidiaries or joint ventures or associates, all of these are your investing activities. These will look at long-term deployment of money, and that is investing activity. However, your accounting has to be in a way consistent, which means if money invested has to go into investing activity, when those investments are sold, the cash inflow will also be investing. So sale proceeds on sale of fixed assets, on intangibles, on investments, everything will go into cash flow from investing. Now the tricky part over here is, what do you do with interest income or dividend income on these investments? Typically, the interest income or dividend income will be taken into the cash flow from investing, unless you are a bank, in which case your main operation is kind of earning an interest income. Other than that, this is more of an outcome of an investing activity, and hence interest income and dividend income will be going into the cash flow from investing. In fact, if there are any taxes attached, like a capital gains tax on the sale of fixed assets, or maybe a tax on, let us say, interest or dividend, that will be taken also with investing activities, where the underlying cash flows go, the incomes, the underlying cash flows go, the tax on that will also be taken over there only. So that is regarding investing activities. And lastly is financing activities. Like investing looks at deployment of funds, financing looks at sources of funds. Like, for example, if you have raised money using equity shares, preference shares, debentures, bonds, loans, all of these money will be raised from the providers of capital, which will go in cash inflows from financing. However, if inflows are going in financing, when you have to make the payment, like for example repayment of loan, repayment of the redemption of debentures, buyback of equity shares, all of these will also go into, let us say, the cash flow from financing activities. An allied tag along thing that will come over here is, let us say, on a loan you have to pay interest, on a preference or equity share you have to pay dividend. Where will these go? Well, these will also be taken along with financing, because if the underlying sources of funds are going in financing, the payments for them will also go into the financing activities. In fact, if there are any attached taxes, like for example with dividend, you have a dividend distribution tax, they will also go into the cash flow from financing. So in summary, you will have a cash flow statement which is a vertical format, where cash inflows will be shown as positive numbers, cash outflow will be shown as a negative number, and you will try to find three separate cash flows from operating, from investing, and from financing. Operating will have day-to-day course of your operations. Investing will have long-term investments or sale proceeds from sale of fixed assets, intangibles, or investments. And in financing, you will have funds which are either raised or, let us say, redeemed or repaid on these instruments. So these are the three items. But when I take the total of these, this will give me the net cash flows that have happened during the year. Now, a cash flow statement at the end will reconcile these net changes of cash flows during the year, add that to the opening balance, and that should ideally give you the closing balance. So when you look at a cash flow statement, unlike a P&L statement which is open, a cash flow statement has to reconcile. Like your net changes in cash and cash equivalents have to equal the opening plus net changes has to equal closing, and hence it is very difficult for management to manipulate a cash flow statement as opposed to manipulating an income statement where they can book fictitious sales, create debtors, book sales. Even if those debtors are not there, you can later write them off as bad debts. In cash flow statement, you cannot manipulate it, because if there are no debtors, you're not going to get money, and hence it's a much more stronger indicator of the company's actual performance. So when I look at the cash flow, we are discussing about interest and dividend, income as well as expense. Now, at the end of the cash flow statement, at the foot of the cash flow statement, you have the opening cash and cash equivalents and closing cash and cash equivalents. Cash, most people would be aware. Remember, cash will include your local currency cash as well as foreign currency cash like dollars, euros, etc. that you're holding is also taken to be a part of your larger cash balance only. But when we are looking at, let us say, when we are looking at cash equivalents, what is there in cash equivalents? Sir, cash equivalents has three pillars. First, it has to be very short term in nature. It has a very short term maturity which is less than 3 months from the date of purchase, not from the balance sheet date. It has to mature. It is not enough that you want to sell it within 3 months. No, it has to mature within 12 months from, has to mature within 3 months from the date of your purchase. Secondly, these instruments should be highly liquid or they should be highly marketable. And thirdly, they should not be subjected to major fluctuations in value. They should have a relatively stable value. They can be converted into a reliable, stable value. So there are three pillars. First, for something to be a cash equivalent, it has to be convertible into a determinable value. It has to have a highly liquid or marketable instrument, and thirdly, it has to mature within 3 months from the date of your purchase. If all the three are satisfied, then that is when it will become a cash equivalent. Like for example, if I were to buy a 90-day government bond or a 60-day government bond does not fluctuate a lot. It is going to mature in around 60 or 90 days, and it has a maturity of less than 3 months from the acquisition date, in which case it becomes a cash equivalent. On the other hand, if I buy a 20-year government bond, it may be a government bond which may not fluctuate as much, but because it is not going to convert into cash, it is not going to mature in the next 3 months, it is not, let us say, a cash equivalent. Further, when you're looking at a cash equivalent, one needs to remember that equity investments or mutual fund units will generally not be cash equivalents, because most of them don't have maturity, and even if they do, like a mutual fund unit, they are not convertible into a determinable amount of cash, and hence they cannot be taken as a cash equivalent. Neither can Bitcoin, which is a cryptocurrency, but it does not give you a determinable or a reliable value, and as a result this cannot be taken as cash equivalent. Now, an interesting thing over here is how do you treat bank overdraft? In your Schedule 3 balance sheet, come what may, bank overdraft will be shown within financial liabilities, current liabilities, short-term borrowings. So it will be a borrowing only. However, for preparation of cash flow statement, you can either treat it as a cash equivalent, or you can treat it, for example, as a financing cash flow, depending on whether the overdraft is a temporary overdraft, that is, it is a part of my cash management activities, or it is like a permanent overdraft. Like for example, if I were to buy an asset, I don't have money, I use bank overdraft, in which case that overdraft will continue for almost the entire year. So when I'm looking at an overdraft to finance certain activities, that means that will be a permanent, almost consistent overdraft. However, what can happen is, if I'm looking at, let us say, a temporary overdraft, like for example, if you have 100 rupees in your bank account and you write a check of 150, then will that check be passed? No, it will be dishonored, and like Rajpal Yadav, you will also end up in jail. So over here, to prevent such as eventuality, we will say that okay, as a part of my cash management activities, I don't need to finance or borrow money for buying assets. But if, let us say, in one of the slack seasons, if there is a big payment, I don't want the check to bounce, and hence I'm using a overdraft facility. So this overdraft is a temporary overdraft, and maybe in one of the months it is an overdraft, other months it is a positive balance. In such cases, overdraft is a part of my cash management activities, and hence that overdraft will be a part of my cash equivalents. So when I prepare the cash flow statement, if the overdraft is a part of cash management activities, how will I know? Well, if it is a temporary overdraft, in which case it will be taken as a part of my cash equivalents. Like there may be cash plus bank minus the overdraft will be my net balance. And if it is, let us say, a kind of a permanent overdraft. It will be a part of financing. This is only for cash flow. Remember, for the purpose of Schedule 3 balance sheet, overdraft will always go into, let us say, your cash flow from finance. For Schedule 3 balance sheet, it will always be appearing as short-term borrowings. In cash flow statement, it can either be a financing cash flow, or it can be, let us say, a cash equivalent, either of the case. Okay, then when you look at, for example, the preparation of cash flow statement, we said there are three parts of the cash flow statement. Investing and financing will remain the same in all cases. However, for operating activities, there are two ways in which the cash flow statement can be prepared. One is a direct method, where I will take the direct cash inflows, that is cash collection, direct cash outflow, that is payment to suppliers, payment for expenses, etc. I will take the direct cash flow, which is very logical. That is called as a direct method. The second method is called as, obviously, indirect, very smart. An indirect method is a method where I kind of hold my ears from the other way around. I say that, well, in an indirect method, I don't have, for example, a direct collection of cash flows. In fact, I will go indirectly. When I say indirectly, I will start with the net profit, and I will have 3 or 4 items which I will separate. So I'll start with the profit. Let's say if it is profit after tax, I'll add back the tax expense that has gone, so it will come to profit before tax. Now, ideally, my profit has to be equal to my cash flow from operations. However, the profit comes with impurities. There are around 3 clear impurities in the profit. Like in profit calculation, there will be non-cash charges like a depreciation, like an amortization, like an impairment, like a write-off. All of these should not ideally affect your cash flow, and hence in your profit I would have deducted these items, so I will have to add it back, reverse it, in order to find my cash flow from operations. That is first. Second, if I look at an indirect method, so first is I'll have to make adjustment for non-cash items. Second, I will have to look at certain items which are in your P&L but they are non-operating. Like for example, interest income goes in your P&L but it is an investing cash flow. Interest paid goes in your P&L but it is a financing cash flow. Loss on sale of fixed assets or profit on sale of fixed asset goes in your P&L but it is a investing cash flow, and hence you will remove all of these non-operating, that is investing or financing items from the profits. So ideally, I've removed the non-cash items like depreciation, amortization, impairments, write-offs. I've removed, for example, all the non-operating items like interest, income or expense, loss on sale of or profit on sale of fixed assets. I remove all of this, which means ideally the number that you should now have should be my cash flow from operations. However, the important problem over here is this number would have been determined by taking sales minus expenses minus salaries minus everything based on accrual principles. Like it is very much possible that your opening debtors were 0 rupees. During the year you made credit sales worth 100 rupees and your closing debtors are 20 rupees. In such a case, my sales in my P&L will appear at 100 rupees. I will say that there are credit sales worth 100 rupees which are made. However, if I prepare my debtors account, my opening debtors are 0, sales are 100, closing debtors are 20, which means during the year I have collected only 80 rupees. When I prepare my cash flow statement, there has to be, for example, only cash that is collected, but my sales which have gone in the P&L are entire 100 rupees, so the cash collection is only 80. In which case, due to the changes in debtors, let's say there's an increase in debtors from 0 to 20. If debtors increase, that means I'm collecting lesser cash. If debtors decrease, that means I'm collecting more cash. Apart from sales, I'm collecting more. But if debtors are increasing, that means if the sales are 100, I'm not probably collecting 100, I'm collecting less, and hence increase in debtors, that is increase in current assets, are typically deducted. This is the same story for debtors, for inventories, for prepaid expenses. If there's an increase in a current asset, you will take the opposite action, that is deduct. If there's a decrease in current asset, you will take the opposite action, that is add. On the other hand, when you look at, let us say, expenses like salaries, या फिर COGS. See, first of all, COGS is opening stock plus purchases minus closing stock. When you look at your payables, in your payables, COGS does not go, purchases goes. So from COGS you have to come to purchases. So opening stock plus purchases minus closing stock will give you COGS. If you have the COGS, you have the opening and closing stock, you can come to the purchases, and these purchases will go into your payables. Or let us say there is salaries, like for example, during the year you have 120, 10 rupees per month of salary into 12 months. So this is 120 of salary. However, opening outstanding was 0, closing outstanding is 10, which means during the year their salary expenses may be 120, you have not paid 120, there is 10 is still payable, and hence your salary paid will be different. So when I do look at the direct method for each of these items, I will directly find the cash collection from debtors, I'll find the cash sales, I'll find the payment to suppliers, etc. I will directly take each of them. But when I look at the indirect method, I'm not showing really the cash payment, or I'm not really showing the cash collection. Then what do? I make an adjustment called as a working capital adjustment, where I will find the change in these operating working capital items, like increase in debtors, you will deduct, increase in stock, you will deduct, increase in prepaid expenses, you will deduct. Current assets will have an opposite relationship. Current liabilities will have a direct relationship, which means over here, if the creditors go up, that means I've paid less. If the outstanding expenses or expenses payable go up, that means I've paid less, and hence that will increase my cash. So the logical thing over here is you will have to make an adjustment for operating assets or liabilities. Changes in current assets has an opposite impact, and changes in current liabilities will have the same direction impact. One needs to be very careful that I will only take the changes over here of operating items which will impact the cash flow from operations. If let us say some of your current liabilities are something like interest payable or a dividend payable, these will go along with the respective interest paid or dividend paid adjustment in the financing or investing cash flows, as the case may be. But other items like inventory, debtors, outstanding expenses, creditors, all of these will impact your, let's say, operating item. Interest payable, dividend payable, and to some extent even taxes payable, because I have to show the tax paid separately, will not be a part of these working capital changes because their effects will be taken separately. And once I remove, like for example, if I look at my profit, let us assume there were no expenses, no non-cash, nothing. My sales are 100, my net profit will be 100. I will say that if there is no depreciation, there's no non-operating item, so my cash flow from operations should be 100, which is wrong. My debtors are going up by 20, so 100 is my profit. And if the debtors are going up by 20, that means I'm collecting lesser cash. So minus 20. So 100 minus 20, that is 80. Will give you my actual correct cash flow from operations. So there are three impurities that I need to kind of clear out when I look at cash flow under the indirect method. First is a non-cash adjustment. Second is a non-operating adjustment. And third is the so-called working capital or the operating assets or liabilities adjustment. Sometimes these operating assets or liabilities may also be non-current. Remember, we usually look at current items over here because current items are those which impact the day-to-day course of your P&L. But there may be certain non-current items as well, like for example, gratuity. Now, gratuity ultimately is also an operating expense. It may be non-current, but it is an operating expense. Or maybe there are debtors which are long-term debtors, in which case as well, you can do this workings over here, and there may be certain current items. Like for example, you might have something like a interest receivable or payable or dividend receivable or payable which are not operating in nature, in which case they will not go into the working capital adjustments. After you do all of this, at the end you will have to subtract the tax paid. So minus tax paid, if you do, minus the tax paid, and that will give you your final cash flow from operations under the indirect method. And well, in an exam, which one should you do? Well, it depends on the data available. Like for example, if you have the data pertaining to only the bank account, you don't have data regarding net profit, you don't have data regarding balance sheet, then the only way you can solve is using a direct method. However, if you have just two balance sheets, you don't have the bank account, you don't have the P&L, in which case you cannot solve using the direct method, because direct method will require you to find the cash collection from debtors. It will require, for that you need sales. It will require you to find the payment to salaries. For that you need the salary expense. If the P&L is not there, you might not have that. And as a result, in such a case, if two balance sheets are available, then indirect method can be found, because you can take the changes in debtors, changes in inventory, and for profits, you can take the changes in profit and loss or retained earnings, as a case may be. And hence, if two balance sheets are available, indirect method is your appropriate method. However, what if there's two balance sheets and one profit and loss available, in which case you can follow any of the methods? Which method? Well, whichever you are more comfortable, you can definitely follow it unless the question guides you otherwise. Though practically, though direct method is much more clearer, it is much more easier to understand. Most of the companies, if you have seen in your articleship, end up preparing your cash flow statement using the indirect method, primarily because they want to show a reconciliation. They want to show, if people question that your net profit is so and so, cash flow is so and so, why is it different? Well, I'm showing you this reconciliation, that these are the reasons why your net profit is differing for cash flow, and hence most of the companies in practice land up with the indirect method, though direct method is a much more clearer and an easier method to in a way understand. Okay, next you have this sample format of the cash flow statement under the direct method. The cash flow statement is for the year. You will start with the cash flow from operating activities, which you can have cash sales, collection from debtors, commission income, and then payment, cash purchase, payment to creditors, expenses, tax paid. This will give you your cash flow from operating activities. Then you go to cash flow from investing activities, which will include interest income, dividend income, sale of these assets, or assets purchase will also come over here. investments purchase will also come over here, and if there's any capital gains tax or tax on interest will also come over here. If it is cash flow from investing, and lastly is cash flow from financing, where you are going to issue these shares, that data will come over here, minus repayment of bonds, buyback of equity shares, dividend or interest paid will come, and less taxes paid if any, like a dividend distribution tax will come over here. This will give you your cash flow from financing. And then you have the net changes in cash and cash equivalent. To that you add the opening cash and cash equivalent, which will give you the closing. It has to reconcile. Now when you look at, let us say, the indirect method, cash flow from operations. Why? Because investing and financing will remain the same whether it is a direct method or it is an indirect method. So when you look at the cash flow under the indirect method, you will start with the net profit. You will find the profit before tax and then make the adjustments. First is a non-cash adjustment like depreciation, amortization. Non-operating adjustment. What is, see, you have to reverse these effects. So if depreciation was an expense, it would have reduced your profit. You added back to find the cash flow. If let's say there's an interest expense, it would have reduced your profit. You added back to find the cash flow from operations. If it is an interest income, it would have increased your profit. You deduct it. So whether interest expense will be added, interest or dividend income will be deducted, loss will be added, gain will be deducted, and then you do the third, that is operating assets or liabilities adjustment. Again, the rule that we said, this will be for something like debtors, creditors, expenses, inventories, even other non-current assets can be considered here if it is linked to operations, that is not investing or financing. The rule over here is if it is a current asset, inverse relationship, that is if it is an increase in current assets, you will deduct, decrease in current assets you will add. For a current liability, it's a direct relationship, but it's an increase in current liability, you will add, decrease in current liability, deduct. It's very logical. If it is an increase in current asset other than cash like a debtor, that means you must have collected less, that is why debtor is going up, and hence you will have to deduct. Increase in current liabilities, if the creditor is going up, that means you have paid less. Paid less means your cash balance would be higher than what is reflected by the net profit related expense, and hence you will add. Okay, so we have shown this impact over here, and we have clearly mentioned that do not include, which we mentioned, interest payable, interest receivable, provision for tax, dividend payable, because they will be taken along with the respective headings. They will be adjusted along with the respective paid headings, and you have tax paid, that is opening tax payable plus tax expenses minus closing tax payable, and that will give you your cash flow from operations. Well, there are a few standard steps that you can follow for the cash flow statement questions, though if you remember certain steps that you've done in inter-CA, you can safely follow that. First is for a direct method, it is a relatively shorter question. Then you prepare a format where 1/3 of the page will be left for CFO, CFI and CFF. At the bottom of the page, post the opening and closing cash and cash equivalents. Then take each line item in the P&L, like sales. You take the sales first, then take the opening and closing debtors and find opening plus current year sales minus closing will be your collection. Even let us say for expenses, opening outstanding plus expenses minus the closing outstanding will give you the paid, and so on. So you will take each P&L item and compare it with the corresponding balance sheet item. Adjust the remaining balance sheet items, if any, after you consider every P&L item like sales के साथ debtors, COGS के साथ inventory, and then with creditors, salaries के साथ outstanding expenses. After you consider everything, then you will have to reconcile the other items. Like for example, that may be PPs or there may be investments, where you try to reconcile that why is if the opening is 100, closing is let's say 90. That means 10 का depreciation होगा. But if your depreciation is only 5, or if your depreciation is for example 20, then you will say ideally your closing should have been 100 minus 20, that is equal to 80. But if it is 90, then 10 must be new purchases. So you have done this a lot in your inter-CA, and then you total the cash flow statement. Pray to God that your cash flow statement tallies. Under the indirect method, you keep the full page for CFO because there will be a lot of adjustments. Then half a page for CFI and half a page for CFF. Again the same thing. Post your opening and closing cash and cash equivalents, and then you start with PAT. Add back tax expenses, deduct tax paid, find that tax adjustment, and then go one by one. Take non-cash charges, non-operating items in the P&L and give effect. Take the balance sheet items. So when you look at the P&L, you will just look at the non-cash, non-operating items and give effect. Then you look at the balance sheet, where you look at the operating assets and liabilities. Follow this rule for other assets, CFI or CFF as a case may be, and then total the cash flow statement. So general, the rule that you should remember is you first prepare the format, give enough space for CFO, then CFI and CFF, post the opening and closing cash and cash equivalent balances, then go one by one. In a direct method, you take the P&L items one by one with their corresponding balance sheet impact and find the collections, payments, etc. And then whatever is the remaining items, try to reconcile. In the indirect method, you start with PAT add back tax expenses, less tax paid, and then take one by one the items in the P&L, here the non-cash non-operating items, and then you look at the other balance sheet items and apply the rules and get your cash flow statement done. Now there can be a special adjustment for certain items, like you can have a capital creditors. These are creditors not for the purpose of goods, these are creditors for fixed asset, in which case they will not go into the working capital adjustments. While doing working capital adjustments, we deduct the capital creditors and do not adjust for them directly. While calculating the payments for PP, we take PP purchase minus capital creditors. Like for example, if your opening capital creditors was 0, closing is 20, you might say that okay, that means 20 is paid less for the operations. Well, no. Well, this 20 is payable for a fixed asset. So if your purchase for fixed assets comes to 50, out of which 20 is still payable, that means 30 must have been paid. A few other adjustments can be, if we discuss, maybe something like a foreign exchange gain or loss on foreign currency cash. Now there's a possibility that during the year the company has done nothing. At the start of the year it had $100, at the end of the year also it has $100, which means there is no cash flow, there is no real cash flow at all. Your CFO, CFI, CFF will be 0. However, at the start of the year these $100 were worth 80, the end of the year these $100 are now worth 90, the exchange rate has changed. In which case, if I look at my balance sheet, I will see a cash balance of 8,000, $100 into 80 opening, and then at the closing $100 into 90, that is 9,000. But that 1,000 increase is not backed by either an operating, investing or financing cash flow. Then what do I do? Well, the standard says you show a reconciliation. You say CFO is 0, CFI is 0, CFF is 0. However, your opening cash is 8,000, your closing cash is 9,000. You show that as a reconciliation over here in the cash flow statement footnote, where you say that the opening cash plus, let us say, unrealized gain. Sir, how is it unrealized? Well, you have not converted the dollar to rupees, and as a result, if the dollar rate again comes back to 80, you will not get that gain. So this is an unrealized gain on the foreign currency cash, which will be shown as a reconciliation, between opening and closing cash and cash equivalents. In a similar way, there can be a lot of other adjustments as well. Like for example, there can be a 0 coupon bond where I've invested 60 rupees and at the end it has become 100 rupees after 4 years. So ideally, if I follow Ind AS 109, in every year I will pass, when I purchase a bond, my entry will be investment account debit to bank. I will show that as a cash flow from investing. In each of the years, my entry will be investment account debit to interest income. Investment account debit to interest income, there's no movement in cash, and hence for 4 years there will be no cash flow. At the end, when I get back 100, that will be again a cash flow from investing. I can show that as a breakup, as 60 as return of the principal and 40 as accumulated interest received. However, this will be like a cash flow from my investing activities. So over here, when I'm looking at, let us say, the cash flow, there can be a few questions which we can kind of review. At the beginning, most of these questions pertain to, I would say, basic identification of cash flow from operations, investing, financing. We'll just do a few important questions over here. So first one is, I mean, it's not an LDR question, but I'm still discussing this. This is for cash equivalents. Here you have a company which is having a 31st March 17 balance sheet, and you have to figure out that which of them are cash equivalents. Like the first one, there's a government bond. Now this is 5% open-ended. Open-ended means it is open for entry and exit whenever the investor wants. So investor can create their own maturity. The main purpose is to park the funds for a temporary period, which means usually I look at the maturity date, but in open-ended fund, I can create a maturity whenever I want to. And as a result, I will say that, well, if I'm parking it for a temporary period, let us say for less than 3 months, it's a government bond, so the value is reliable, it is liquid, and hence I will say that this is a cash equivalent. A fixed deposit with SBI, it's a 3-year maturity on 1st January 20, it is not a cash equivalent. Fixed deposit with HDFC, it's a 10%. Original maturity was for 2 years, but the maturity is due on 30th March. So if I count from the balance sheet date, it's just 3 months away. But for cash equivalent, I don't count from the balance sheet date, I count from the date of acquisition, and hence this is not a cash equivalent. Point 4 we will see. Point 5, 6 and 7, these are cash balances in India, international branches or foreign branches. We will say it does not really matter. These are actual cash only or cash equivalent as a case may be. Bank overdraft as SBI Food, it is temporary overdraft, and hence this is a cash equivalent because it is temporary in nature. And treasury bills with a 90-day maturity, they will also be taken as a cash equivalent because they are treasury bills, so that is government giving you a reliable value, and the maturity is less than, let us say, 1 year, and as a result less than 3 months, and hence this will be a cash equivalent. Now redeemable preference shares in ABC, they have said redemption is on 30th April 17, that is in 1 month, but you have not been told when they were purchased. If they were purchased after 1st of February 17, then their holding period is less than 3 months, in which case they can be taken as cash equivalents even if they are preference shares. Equity shares cannot be taken as cash equivalent because they don't give you a reliable value, but preference shares do give you a reliable value, and hence they can be very well taken as cash equivalent if the maturity period was less than 3 months. if let us say the maturity period is more than 3 months, that is you have purchased before 1st of February 17, then they are not taken to be cash equivalents. So that is about it in terms of cash equivalents. Then there were a few other adjustments. This is question 6, a very basic question, but it came in the recent RTP as well, I think of May 26, where a firm is investing in a zero coupon bond with a face value of 10 lakhs by paying 5 lakhs. So this 5 lakhs is my cash flow from investing. It's a cash outflow. The effective rate is 15%. The firm recognizes proportionate income in the income statement throughout the period. However, there will be no cash flow impact. How will the interest income be treated in the cash flow statement during the period of the bond? No effect. Why? Because it is a zero coupon bond. But on maturity, you will receive the entire 10 lakhs. This will be CFI, cash inflow, and you can show this split between 5 lakhs of principal, 5 lakhs is interest collection, and that is absolutely fine. Acha, then there is this thing of tax payment. Usually when you pay tax of 5,30,000 during the year, out of which 30,000 is paid for long-term capital gains, in which case I will say 5 lakhs will go as cash flow from operating and 30,000 will go as, let us say, cash flow from investing, because it is on capital gains which must have gone at the time of selling, and hence that you will take it accordingly. Tax will go where the underlying item is going. Acha, this is 8, which is on barter. You have a fixed asset of 10 lakhs. Which is acquired by accepting liabilities of 8 lakhs and paid the balance amount in cash, in which case your entry is asset account debit 10 lakhs to, let us say, loan which is 8 lakhs to bank 2 lakhs, in which case your investing activity will be 2 lakhs only. Whatever is net cash, only that you will be taking. Achha, now you will go to the important questions. The earlier questions were just basic concept builder. In case you have certain adjustment, you should be aware of it. Achha, then you look at question number 9. Z has no foreign currency cash flow in the year 2017. It has some deposit in a bank in the US. The balances in December 17 and 18 were $1 lakh and $1,02,000 respectively. Maybe 2,000 is the interest which must have been earned. The exchange rate at the start is 45. So this is 1 lakh into 45. That is 45 lakhs must be appearing. And the same at 31st March 18 was 50, which means 1,02,000 into 50 will come to, I think, 51 lakhs, which means during the year there is an increase of, I think, 45 lakhs to 51 lakhs. There is an increase of 6 lakhs. The increase in the balance was on account of interest credit on 31st December 18. At the end of the year, interest was credited. Thus, the deposit was reported at 45 lakhs in the balance sheet on 31st December 17. It was reported at 51 lakhs as at 31st December 18. Okay, how will these transactions be presented in the cash flow for 31st December 18 as per Ind AS 7? So, if I look at this, there's a $2,000 interest which is credited at the end. So, $2,000 into 50, which comes to approximately 1 lakh rupees. This is an actual cash flow. Well, this can be operating or this can be investing, either ways. If let's say this is linked to a day-to-day cash management, it can be linked to operations. Otherwise, most likely this will be linked to, let us say, investing, like I've put a deposit, and hence there can either be a cash flow from operations or you can even show it as a cash flow from investing. This is 1 lakh rupees on account of interest income received. Now, when I'm looking at, let us say, the net changes come to 1 lakh. Your opening cash in your books is actually 45 lakhs. Now, 45 plus 1 is 46. However, your closing is 51. Why? Well, there's an unrealized foreign exchange gain on 1 lakh, not on 1 lakh 2. 2,000 is already recorded at 50 only. So, on 1 lakh dollars at the rate of 5, there is 5 lakh, and then 45 plus 1, that is equal to 46 plus 5, and hence this will come to 51 lakhs. Okay, so this is an important thing. Question number 10 is largely on factoring. It's a theory case. An entity entered into a factoring arrangement and received money from the factor. Remember, factoring is taking money on a loan on the security of a collateral, usually if it is a recourse factoring. Examine the said transaction, how it will be presented in the cash flow. Well, if it is a recourse factoring, then it is a financing cash flow. I'm just taking a loan on the back of the factor. Non-recourse factoring, then it is collection on the debtors. I'm not taking a loan. Then it is collection of the debtors, and hence it will become an operating cash flow. Not an LDR question, but nevertheless. So even question number 11, 12, 13, these are basic cash flow preparation questions. Now 14 is a fairly complex question. We will see how to kind of take this question into consideration. There are quite a few adjustments. So this is an important one. A Limited, whose functional currency is the Indian rupee, had a balance of cash and cash equivalent of around 2 lakhs. Okay, but there are no trade receivables, no trade payables as on 1st of April 11. During the year 11-12, the entity entered into the following foreign currency transactions. So if I look at my opening balance sheet, there was a cash of 2 lakhs and there was no debtors, creditors, nothing. on A purchase goods for resale from Europe at 2 lakh euros when the exchange rate was 50. So 2 lakh euros into 50 will come to around 1 crore rupees. Your entries purchases account debit, let us say to creditors. The balance is still unpaid on 31st March 12 when the exchange rate is 45. Now these creditors are monetary items and hence they will be remeasured at the closing rate. So 2 lakh euros into 50 minus 45, that is equal to 5 rupees. So that is around, I think, 2 lakh into 5, that is equal to 10 lakh of an exchange gain. Entry will be creditors account debit to forex gain and this will go to the P&L. Remember, this gain is unrealized. An exchange gain on retranslation of the trade payables of 10 lakhs is recorded in the P&L. Perfect. So there will be a 10 lakh gain in the P&L account, unrealized. Unrealized gain. Okay, then A sold goods to an American client for $1,50,000 when the exchange rate was rupees 40 per dollar. So 1,50,000 into 40 will come to, I believe, 60 lakh rupees. So entry will be debtor account debit to sales, 60 lakh rupees. The amount was settled, money is received when the exchange rate was 42. So your entry will be 42 into 1,50,000. I believe this will be 63 lakhs. And a further exchange rate gain on the trade receivable is recorded in the statement of P&L. So over here, your entry will be, I think, 1,50,000 into 42, that is right, 63 lakhs. So there will be an entry bank account debit, for example, 63 lakhs. To, let us say, debtors 60 lakhs to forex gain of 3 lakhs, but this 3 lakhs of gain is basically realized gain, and this is linked to operations. This is also operation, this is also linked to operations. A borrowed 1 lakh under long term arrangement when the exchange rate was 50, so that is 50 lakh rupees, and immediately converted to rupees. The loan was retranslated at 31st March at 45. Remember, this is exchange rate monetary item, so there will be a forex gain of 1 lakh into 5, that is 5 lakh rupees. Exchange gain recorded in the statement of P&L, this is 5 lakh, but this is unrealized, but this is not linked to operating, it is linked to financing actually. See, the first two items may be realized, may be unrealized, but they were linked to operations. The gain or loss on the loan is linked to financing. A therefore records a cumulative exchange rate gain of 10 lakhs on the first thing, 3 lakhs on the debtor and 5 lakhs on the loan. So that is around 18 lakhs is recorded in the profit and loss account. Out of this 18 lakhs, we can only say 3 lakhs is realized in cash, other is not realized in cash. In addition, A Limited recorded a gross profit of 10 lakhs. Sir, how did you calculate 10 lakhs? 60 lakhs minus 50 lakhs. I don't know how on the sale of these goods. Ignore taxation. So over here, if I were to prepare my profit and loss account, my purchases initially will be recorded at 1 lakh euro into, for example, or 2 lakh euro into, for example, 50. So my purchases will be 1 crore. My sales will be recorded as debtor account debit to sales, $1,50,000 into 50. That comes to around 60. But if my GP is given to me, GP, this is before all of these interest incomes will go in NP, net profit. If my GP is given to be 10, that means there is a balancing figure of what? 50. This must be closing stock. Well, it must be that I've purchased goods worth 100, but 50% of those goods are sold, 50% of the goods remain unsold. And hence, if I want to calculate, let us say, using the indirect method, I need changes in inventory. I might have the opening debtors, I might have the closing debtors, I might have the opening creditors, closing creditors. I don't have the stock. So maybe this will be helping me find the stock. Ignore taxation. Okay, so what are we supposed to do? How will the cash flows from the above transaction be reported in the statement of cash flows under indirect method? Remember, if this was a direct method, you don't need to bother about anything. Under the direct method, cash collection from debtors will be 60 lakhs plus 3 lakhs, that is 63 lakhs, end of story. That is it. On creditors, you have not paid anything. Loan, you have received money, but that is a financing cash flow. It is directly 63 lakhs, which is cash flow from operations, and then from financing, I have converted that and I have received 50 lakh rupees, that's it. But if I'm using indirect method, then it is a problem. Well, I have to start with net profit. Well, net profit over here is around 18 lakhs. Okay, no, not 18 lakhs. Maybe GP is 10 lakhs. And after GP of 10 lakhs, there is a 18 lakhs other income. So there will be 28 lakhs, I believe. Yes, so your net profit will be 28 lakhs, will show a working. Now from this, whatever is unrealized, you can remove. So your unrealized foreign exchange on loan will be removed, unrealized foreign exchange on trade payables will be removed. Both of these are removed. See, within this 3 lakhs is there, but 3 lakhs is realized and hence you don't need to remove it. It is linked to operations and it is also realized. It is linked to debtors, that is operations, and also realized. Now, other than that, there is no depreciation or anything over here. You will try to find the changes in working capital. In working capital, your debtors are 0. You originally had a 60 lakh debtors, you collected 63, took the gain or loss in the P&L, debtors are 0. But there's creditors. Your opening creditors were actually 0, but during the year your creditors increased. due to the purchases, they increased by, let us say, 1 crore. Now you might say, no, after foreign exchange change of 10 lakhs, they will become 90 lakhs. But I have reversed the foreign exchange impact earlier. If I have already reversed the foreign exchange impact, I cannot again consider the foreign exchange impact and show a creditors at only 90 lakhs. So I will say that, okay, I've already reversed the foreign exchange impact. So had there been no foreign exchange impact, my creditors would have been 1 crore. And these are increase in creditors. And increase in creditors I will add. Increase in trade payables I will add. Similarly, there is, let us say, loans, but loans are not going to come over here. Inventory, opening inventory was 0, closing inventory is 50 lakhs. If there's an increase in inventory, you will deduct. Increase in inventory, you will deduct, and this is deduct by 50 lakhs. And if I now do this working, I will get exactly 63 lakhs, which is my cash flow from operations, which is going to be taken. Even direct method would have taken this 63 lakhs probably directly. Are we clear with this? Okay, so over here, this kind of takes care of the cash flow from operations. If you look at cash flow from financing, I would say that I've collected 50 lakhs. Now one can say that there is a foreign exchange loss. My currently loan will be 45 lakhs, but let's say there was a foreign exchange loss or gain of 5 lakhs. If I were to reverse that, 45 and 5 will come to 50 lakhs. Remember, whatever is a loss has been reversed earlier, so you can't really take the effect of that. But as a matter of fact, in my bank account, when the loan was taken, the entry is bank account debit to loan, and hence 50 lakhs will come over here. So this is pertaining to your question number 14. It's a slightly more complex question. We have prepared a detailed trading account extract of balance sheet for a clear understanding. Though if nothing is asked, you can directly use the direct method and solve for this. The thing that you have to remember is you have to ensure that these foreign exchange gains or losses which are unrealized, you don't end up giving no effects or you don't end up giving double effects. If you are taking the unrealized gain or loss, reversing it at the top, then the other amounts like creditors or loans also you have to find without the foreign exchange gain or loss. Why? Because that gain or loss, if any, has already been reversed, and hence that creditor balance or the loan balance should be also after reversing or ignoring that loss adjustment. Or if you don't want to do this, well, you can skip showing this 10 lakh loss over here, in which case this will be appearing at 90 lakhs and your answer will remain the same. Remember, for loans I have to show because loans is a financing activity, so I'll have to reverse it from the operating in any case. Okay, so either of the ways you do, that will work. Now question number 15 is also an interesting question which Institute loves asking. If you see, multiple times this has come. This is a question where they are trying to have a cash flow statement of a company where an acquisition has happened. So whenever there is an acquisition happening, there must be some cash paid, and if that cash is paid, that is to acquire a company, and that will be taken as cash flow from investing activities. Now what will happen is in the consolidated financial statements, you will pay that cash and in return receive an entire business, and in that business also there can be some cash that you will take over. So whatever is a net cash, that is a cash that you are paying to the shareholders, minus what is the cash that is received on the entire net assets taken over, that net cash will be shown as a cash outflow from investing activities. Now after I consider that cash outflow, everything which is pertaining to the net assets taken over, like a PPE purchase, inventory purchase, you have taken the payment for that, and hence when you calculate the changes, you will calculate the changes in an adjusted way. So you can either take the closing, ideally you take changes as closing minus opening. So during the year there must be some increase in the assets, but that may be due to acquisition, but for acquisition jo bhi payment hua, we have taken it separately. So either you adjust the opening, that is you will say closing minus opening plus the balance is taken over, and that will give you the net changes, or you adjust the closing, that is you take the closing out of which remove the balances that are taken over, and then the net amount you compare it with the opening, and that's about it. It sounds a little confusing, but if I were to do it in a number set, it will be a lot more clearer. Entity A acquired a subsidiary B during the year. The information in the consolidated P&L account is provided, so you have this entire P&L account given and this entire balance sheet given. Other information, all of the shares of B were acquired for 74,000 in cash. So this is your cash flow from investing. 74,000 is paid. The fair values of the assets and liabilities are, so you have been given the assets and liabilities taken over. So if I take all of these, well, including on the next page, you have a goodwill of 18,000, that is 74,000 payment. Prepare the cash flow statement. So I'm saying 74,000 is the cash paid, but along with that I've also received cash of 2,000, and hence my net, I am paying 74, net I'm receiving 2000, and then 72,000 will be my cash flow from investing activities. When I look at CFI, there will be net cash paid on acquisition of 72,000. Now against that, if I were to prepare a cash flow statement, I can prepare it using the direct or indirect method. If I take it profit after tax, add back tax, will come to profit before tax. To that you will add back depreciation, add back interest, and that's your regular working tax. Add back depreciation, add back interest, and then you do working capital changes. Now when you do working capital changes, you typically take your trade receivables, for example, which are 54 and which is 50. So basically I will say there's an increase of 4,000. However, during the year there must be 8,000 which are taken over. So you either do 50 plus 8, that is 58, and then compare it with 54, in which case there's a decrease of 4,000, and hence you will add. Or you can do 54 minus 8, because either I include that 8 at both places or I exclude at both places. 54 minus 8, that comes to, let us say, 46, and 46 minus 50 will again come to, let us say, a negative 4. A decrease in 4, which means you will add. Okay, similarly, if I look at, for example, inventories were 4,000, so I will add, let us say, the inventory is worth 4,000, so this is 39, and compare it with 30, so there is a decrease of 9,000, you will add. And when you look at the trade payables, your trade payables, so this is already taken, trade payables over here is 32,000, so there is 32,000 of trade payables. I will say, where is the trade payables, plus 32,000, so this is around 92, which is now 68, and hence there is a fall of 24, which means direct relationship you would deduct. Now when you look at PP or long-term debt, now long-term debt is going up by 36, so if you look at your long-term debt, 64 plus 36 will come to 1 lakh, no other changes. So it's not that new money is received, that debt is taken over, because of which your loan is increasing. Your PP is going up by 1 lakh 10. So if I were to add the PP, opening PP, 80,000 plus 1 lakh 10 will come to around 1 lakh, I think 90,000, minus depreciation. If given of around 30,000 will come to exactly 1 lakh 60, which means there's no further purchase apart from what is there. So the only adjustment that you will have to remember is this cash payment, and then when you're doing these comparisons, all of these comparisons will be done after considering these assets which are taken over. So this is pertaining to question number 15. I believe we have also given a note for this somewhere. Yes. So what should be done in case there is, let us say, an acquisition. Okay, next is a fairly good question. I would say 16 is one of the better questions. There are a lot of adjustments over here, and you are required to determine just a cash flow generated from operations. So you don't have to show everything, you just have to show CFO for group reporting purposes for 31st March 12. So this is pertaining to cash flow. So let's review this. So you have for A the entire, you have the extract, you don't have the entire cash flow. So you'll have the assets, all of this data given, and consolidated profit and loss account. See, a couple of important things over here is there's an investment in associate which is appearing, and then there's a profit from the associate. Remember, when you do equity method of accounting, the share in profit of the associate you record as investment account debit to consolidated profit and loss. It is a non-cash item. This is a new adjustment where you will say that this is, let us say, a non-cash item. Following are relevant for the group. A has spent 30 lakhs on renovation of a building, and he has charged the entire renovation cost to the profit and loss account. So if I were to take the PAT, I will first have to find a rectified PAT. So 1840 is after deducting this renovation, you will have to add it back. On 1st April 11, A acquired 100% shares of S for a cash of 300. The fair value of these assets and liabilities are as under. So you have all of this PP, inventories, trade receivables. It is same as your earlier question number 15, and a cash of 20 less trade payables, and you get a number. So if I were to calculate the cash flow from investing, this is 300 minus 20, that is equal to 280, will go as cash flow from investing. In cash flow from operations, what will happen is you will take the adjusted balances like 60, 30 and 50. So I will take the balances as inventories is plus 60 in the opening, trade receivable is plus 30 in the opening, and trade payables is plus 50. Alternatively, you can also take your closing message, you can subtract. Either ways works. A's PP comprise of the following: 4650 additions, revaluation, disposal, depreciation, and you get a carrying value. A constructed a machine that is a qualifying asset, and the incurred construction cost of 40 lakhs that has been charged to other expenses. Now this is a construction cost, cannot be charged to other expenses, it has to be capitalized along with the asset. So plus 40, your profit is wrong. You'll have to first rectify it. Interest cost of 110 charged to the profit and loss statement, of which 10 is interest on specific borrowings that need to be capitalized. So your actual interest going in the P&L should be 100, not 110, and hence this 10 rupees will be added back. My interest will be only 100 ideally. Okay. PP was sold at 630 lakhs. The gain on disposal is adjusted in the operating expenses. PP is sold for 630 lakhs. Now maybe depreciation over here is 290, disposal, that is, so maybe the gain on sale must be 630 minus 490, which is there in your books. So maybe this is what, 140. This must have gone into the P&L account. You will have to reverse it when you are calculating the cash flow from operations. A purchased a 30% interest in the associate for cash of 1st April 11. This must have gone in investing activities. The associate reported a profit of 400. Achha, I have a 30% stake, so 400 into 30%, 120 must be added. And paid a dividend of 100. Achha, I would have received 100 into 30%, that is equal to 30. But this 30 will be cash flow from investing. It is not a cash flow from operations. So when I calculate the profit, I will have to first find the rectified profit, which is 1840 plus 30 plus 40 plus 10. So this is probably 1920. This is my correct profit in my cash flow statement, and then I will have to adjust for items like gain on sale of fixed assets, items like unrealized profit on associate, etc. Impairment test was conducted on 31st March 12, and there's a goodwill impairment loss and intangible impairment loss. These are non-cash in nature, and hence you will add it back. Goodwill relates to 100% subsidiaries. Assume interest is paid in cash. So if I were to find the cash flow statement, first of all, I'll have to find the rectified profit. That is 1920, as we said. Now from the rectified profit, I will add back non-cash items, like I will add back depreciation if any. Sir, what is the depreciation? Maybe depreciation is 290. I will add back 290 worth of depreciation. I will deduct the gain on sale of PP of 140, which must be a part of my profit correctly, but for cash flow, I will have to deduct it. I will add back interest, which is 100. 110 tha, but 10 I've already adjusted, so this is 100. I will add back. Then I will add back, or I will remove, this is very important, the share in profit of an associate. Now one can say I'm removing this, but I'll have to add the dividend. That dividend will go in cash flow from investing, not cash flow from operations. And then there is goodwill as well as intangibles impairment that you will add back, and that's about it. Now other than that, you have to do working capital adjustments, and while you are doing working capital adjustments, if I do it for one of them, let's say if I were to do it for trade receivables, I will say this is 1830 in the opening and 1250 in the closing, and hence if I subtract this, it is around 580. Alternatively, I'll deduct 30 from 1250, get 1220 and compare it with 1880, I'll still get 580. It's a decrease, and hence I will add. So if it's a decrease, I will add, let us say 580. The same is the adjustment you do for inventories, the same is the adjustment you do for trade payables, and that will give you your cash flow from operations. Now you need more data to find cash flow from investing and financing. You don't have sufficient data, and hence in this question they have not even asked you, they have not even given you the entire balance sheet. So if you sit and find, your cash flow statement will not tally because you don't have enough information for the same. Okay, next we have question number 17. A acquires 70% of the equity shares on 20th July. The consideration paid is cash of 15 lakhs and 2 lakh equity shares of rupees 10 at a fair value of 15. On the date of acquisition, B has a cash and cash equivalent balance of 2 lakh 50 in its books of accounts. On 10th of October, A acquires a further 10% stake in B for a cash consideration. See, earlier 70 is acquired, now another 10 is acquired for 8 lakhs. Advise how this transaction will be presented in cash flow. They have not asked you whether it is standalone cash flow or consolidated cash flow, so we will discuss for both. Now for standalone cash flow, my entry at 70% stake will be investment account debit to bank, let's say 15 lakhs, to share capital, let us say 20 lakhs, to securities premium, let us say 10 lakhs. So if I 45 to bank, to equity share capital, to securities premium, as the case may be, I will just show investing activity at 15 lakhs. That's about it. Further, if I look at consolidated, I will take over the net assets. Now these net assets include cash of 2 lakh 50. Net assets account debit, again to bank, let us say 2 lakh 50, to share capital, to securities premium. So I will pay 15 lakhs, but I'll receive 2 lakh 50. So my CFI over here will be 12.5 lakhs only. Like here CFI will be 15, here CFI will be 12.5, because 2 lakh 50,000 of net cash will also be received. Achha, then when I acquire another 10% stake in SFS, my entry will be investment account debit to bank, that is 8 lakhs, and hence there will be a CFI which is worth 8 lakhs clearly. However, when I look at CFS, this is interesting. this 10% is treated as purchase of NCI. So your entry will be NCI account debit. Whatever is a gain or loss will go in other equity to bank. Let us say, but NCI is a provider of capital. It is a financing cash flow, and as a result, this will be a cash flow from financing worth 8 lakhs if this has to be shown. This is question number 17. 18 is there. I mean, 19 can be discussed, but 19 is more of a preparation of cash flow statement. All of these are relatively, I'll just review 19, but this is 19 which you should actually pause and try on your own. It is an entire question, but let us say there's an entire balance sheet given over here, and there's a profit after tax which is at 4450. Profit after tax, there's interim dividend of 450. Depreciation and amortization is given to you. During the year, 2 machineries were sold for 70 lakhs and the carrying amount of these machines was 60 lakhs. Income tax paid is given as 105. Acha, this is an important thing. Other non-current assets or current assets and liabilities are relating to operations, and hence even if they are non-current, they will impact the cash flow and do not contain any element of investing or financing. From the above, construct a cash flow statement under the indirect method. So what you will do is you will prepare this entire format. You will start with the net profit which is given to you as 4450, to which you will add back tax. So you have been told that the income taxes during the year is 105. You will add that back, come to profit before tax. At the bottom, subtract the tax paid, which is also 105. So that is the first part. You would have added the opening cash and cash equivalents, but just that in cash equivalents, an important thing over here is there is a bank overdraft. So over here, when you calculate the cash equivalent, if nothing is given, you will assume that the bank overdraft is temporary, and hence in your final cash and cash equivalent balance, you go to see over here 460 minus 60 and 225 minus 75. So you are assuming bank overdraft is a part of cash management and accordingly solve. Achha, next, when you go to the workings one after the other, you will look at, let us say, the items, and you will see that whatever is non-cash, non-operating, you will add back, like depreciation, amortization. You will try to find a gain or loss on machinery, like during the year 2 machines were sold for 70, carrying amount was 60, so 10 would be, let us say, the gain that you will reverse. Achha, and then highlight this, there is an increase in deferred tax asset. Remember, deferred tax asset is non-cash in nature, so when I do the changes one by one, I see a deferred tax asset, this changes, your entry must be deferred tax asset account debit to P&L, so this is a non-cash item, and as a result you will reverse it. Then adjustment for operating assets, like you will take even other non-current assets, other non-current liabilities. The question very clearly tells you other non-current or current assets are all pertaining to operations only. So you will take that into your calculation, come to the cash flow from operations. Then you have sale of machinery, purchase of PP, intangibles, very typical inter-CA type of a working. In cash flow from financing, you will have interim dividend, repayment of long-term borrowings. I want you to try to solve this once. If you had to solve one question, probably this is that one question where it is very unlikely that a question of this size will come in your exam. You see, if it is all MTP, RTP study material questions, it is not an exam question, because it is very unlikely that the institute will dedicate so much marks for one cash flow statement. But if you want one question where you want to get clarity, this is how you will do. You will prepare the format, 1 page for cash flow from operations, half page for investing and financing. Then at the end, cash and cash equivalents, where you deduct the bank overdraft, find the net balance, start with the profit, add back tax, subtract the tax paid, then all the non-cash items, whether it is depreciation, amortization, impairment, deferred tax, non-operating like interest, gain on loss on sale, adjust all of these items, and you will reach, let us say, a particular point. After that, you have to do the working capital adjustments. There is no merger and acquisition in this, so you directly take the difference between opening and closing. Current assets is increasing, opposite relationship, current liabilities, direct relationship, and solve. Here, not just current, and you will take other items as well, like other financial assets, non-current assets. They have told you clearly they are linked to operations, and you will take this in the working capital adjustment only. And other than that, like you do in your inter-CA, you find the PP that is purchased, sale proceeds on sale of PP, dividend paid, loan repaid, etc. And that kind of takes care of your cash flow. I believe that is kind of sufficient to get a reasonably good understanding of the cash flow. But having said that, it is important that you try to prepare a cash flow statement, and that is about it. Okay, so I hope you have got a good broad understanding of this chapter, and that kind of takes care of your Ind AS 7 revision as well.